So this next session in the plenary room here is going to be on how impact managers can bridge the gap between the market demand and offer of impact products. So impact finance has been a niche market for a long time, appealing to more specialized investors, perhaps like development banks, and drawing both public and private capital. But more recently, as we've already heard, the interest is increasingly significant, and the investors are broadening their interest and their reach. So please do come in, because we have a fabulous panel, 5 speakers in this discussion. So hopefully in 2 minutes more people will be in the room, including the speakers themselves, and we can start in about 2 to 3 minutes. Thank you very much. So, hello again, everybody. I would encourage people to sit as quickly as possible, because I want to give the panel as much time as possible for them as well. This is going to be a panel discussion on how impact managers can bridge the gap between the market demand and offer of impact products. Please do come to the front. We have plenty of space in the front. If you can make your way, you can bring your coffee with you and your croissant. Super. Okay. So please welcome to the stage Aurélien Hollard from CMS Luxembourg, and once more Sigrid Toffer-Dottir, Impact, Marius Chirla from the EIB European Investment Bank, Stephen Evers from Triple Jump, and Xavier Pierluca from Enabling Capital. Please welcome them to the stage. Thank you.
No? Yeah, sounds better. Yeah, indeed. Hi, everyone. Thanks a lot for being present, so here in the room or online. I understand there is a bit of competition with this panel and other sessions, so thanks again for people selecting this panel, which, I think is about is not a new topic at all. It's about bridging the financing gap. I am, of course, with my panelists, not new in the space. Impact is something we know since many years, more than a decade. And I think since the year 2000, since the year 2010, we were just expecting the big wave, you know, the big money coming to the impact sector. We also, you know, thought that the regulatory landscape, with the evolution on SFDR, on the taxonomy, so all this ESG regulation could potentially benefit the impact industry as a whole. There were other trends in general. Alternative assets are more and more popular, and impact funds are alternative investment funds. We recently have a new wave of investors through the more what we call democratization, retailization of the industry, and this is maybe as well another opportunity for impact players. But it's true that despite all those new trends, it remains quite uncertain whether we are facing a big wave of money for impact funds, impact projects. And at the opposite of the spectrum, we, for instance, as lawyers, we assist investors in their due diligence in impact funds. And there seems to be as well some misalignment from investors thinking that there is not enough impact projects, which when you are in the impact space, you feel it's not possible to hear, while it's still part of the reality. So that's really the intention today on this panel, is to focus on that topic of bridging the financing gap. We will, of course, focus on what we see, on maybe the issues we can notice, but as well on options, on solutions to increase the flow of capital into impact funds. And so for today's panel, I'm very happy to be surrounded by such well-established and experienced practitioners. I'll present them and then ask them, each of them, to give a brief explanation on their firm and their activities. So I'll start, of course, with Siga Torfadotir, who is conducting officer and head of fund management services at Impact and based in Luxembourg. I'm also joined by Stephen Evers, CEO at Triple Jump, which is an asset manager based in the Netherlands, but I'm almost sure everybody knows him. I'm also joined by Xavier Pierluca, traveling from Switzerland, who is managing partner at Enabling Capital as well, an asset manager. And last but not least, we also have an investor perspective today with Marius Kirilla, who is Senior Investment Officer at the European Investment Bank, of course, established in Luxembourg. So I'll ask maybe quickly Siga to introduce yourself, and then we'll start with the question.
Thank you. So I'm Siga, heading the fund management services at Impact. Through the fund management services, we provide support to impact fund initiators and managers through our impact finance platform, which includes the regulated fund management services both here in Luxembourg and in Mauritius, a bond platform, and various other ways of supporting through our advisory support. So that our fund managers or our clients can focus on making impact on the ground.
Thank you, Siga.
Happy to be here.
Yeah, thank you. Marius?
Hi, good morning, everybody. My name is Marius Kirilla. I work for the European Investment Bank, which is a multilateral development finance institution that has a core focus on lending to European businesses and infrastructure projects. So what am I doing here? I work as part of a team that is covering investments into private funds across emerging markets. From a product perspective, our focus is on private equity, venture capital, and impact funds. And from a geographical perspective, our core focus is on Africa, but we're also covering selectively other global emerging markets.
Thank you, Marius. Xavier?
Hello, very happy to be here. Xavier Pierre-Lucas, Managing Partner, Founder of Enabling Capital. First of all, I would like to thank CMS for inviting me on that panel, and I would like also to thank again the ICFF, from which we received support actually in before 2020 in order to launch one of the products that we currently manage. So I was part of the cohort, and it's always a pleasure to be back and meet with new cohort members as well. The company Enabling Capital, we're incorporated in Switzerland. We are a regulated fund manager, regulated by FINMA in Switzerland. We currently manage 2 products with a total asset under management around $700 million. One of the fund is an open-ended fund, the Enabling Microfinance Fund. We operate across 40 countries with 150 actually lines of credit to different microfinance companies, fintech, housing finance vehicles as well. And we manage the Spark Plus Africa Fund, which we launched actually, as I indicated, thanks to the support and with the support of the ICFA, which focuses on access to energy and more specifically clean cooking. Clean cooking in sub-Saharan Africa, so we invest across the value chain of different fuel types, biomass, biogas, solar, LPG as well. We work with different instruments and work as well on carbon project transactions, Article 6 voluntary market, always with the purpose of actually providing access to different populations in sub-Saharan Africa to modern and clean cooking solutions. We have offices in multiple geographies, in Quito, in Nairobi, Karachi, Bangalore, as well as Bishkek, and of course in Switzerland. And looking forward to discussing, how basically we can bridge the gap, looking at plain vanilla fund, looking at different instruments and blended finance products, of course, today.
Yep, there will be some discussions around those products. And of course, Stephen.
Yes, good morning, everybody. Thank you, Aurélien, for inviting me on the panel. My name is Stephen. I'm with Triple Jump. We are a pure play emerging market fund manager. We have expertise in private debt, private equity funds, and also knowledge transfer. We focus on micro and small enterprise finance, affordable housing, and access to energy and everything with an overlay of gender and climate resilience. It is my personal ambition, has always been to crowd in private investors and particularly institutional investors for places where needed most. I think low income, low middle income countries are where we want to go. I haven't been that successful in recent times, and I'm glad we can discuss that in this panel.
Thank you, Stephen. And indeed, maybe without doing any spoiler alert, I think we feel indeed that there is still a real financing gap. And probably we wanted to, in a way to start maybe from the roots and end up in a more positive approach. Have first some discussions around why we feel there is still a true financing gap, while it is still kind of complex to crowd in private investors in true impact products, despite the new trends around ESG. But as well in the second part, more focus on the reasons, the solutions for the future and what are the options to crowd in more private capital. Start maybe, so I asked each of them to select one particular reason why there is this financing gap. I think Xavier, we discussed about the size of funds in general.
Yes, fund size does matter actually. And before we start, I think something important is to provide some data around fund sizes in the market, generally speaking. So today, more or less, you have 500 impact investment funds, private capital funds out there operating in emerging markets, but also developed markets, with an average fund size between $80 to $100 million, more or less. This is data from private asset investment fund or impact fund, forgot, and other impact assets data as well. These funds are managed by 300 managers as well. So it's a sector that is quite atomized, as you can tell. If you look more closely into the sector, you will realize that 15% or 10% of the funds actually represent more than 80 to 90% of the capital that has been raised so far in impact investing, mainly from two types of strategies, microfinance and more recently climate, which is a rising asset or sector, if you like, in impact investing. Something interesting, when you think of fund sizes as well, is that, of course, it's closely tied to the possibility to welcome institutional investors. And when you speak with pension funds, insurance companies, most of them tell you that they deploy minimum ticket sizes of 10, and in most cases, $25 to $50 million. When, of course, you have a fund, average fund size that is for 90% of the sector below $80 million, close to $60 million, it's actually quite difficult to crowd these guys in, as Stephen, you indicated earlier as well. And it has actually gotten worse, right? Because 20 years ago, and we'll speak about blended finance, but blended capital or public capital allowed institutional investors, pension funds, to actually invest in microfinance at the time. And they were writing much smaller tickets than the ones I mentioned. And following the crisis, or several crises, tech crisis, mortgage crisis, increased scrutiny on regulation, risk and compliance matters as well, plus the rise of liquidity in the market, all of these investors, decided to focus their attention on larger fund sizes, basically making, our lives as impact fund managers more difficult when we want to raise investors' money for pioneering new strategies, which we will be discussing as well in blended finance. Something else when we fund size as well, and tied to regulatory matters, is also the type of fund vehicle that we can incorporate in multiple jurisdictions to actually welcome investors, and that in some cases are way too costly for the type of fund sizes that we want to manage in order to attract investors, since we have total expense ratios that are basically increased to an unreasonable amount as a result of that. Fortunately, Luxembourg has some solutions, and I'm sure we'll speak about these later on.
Yeah, thank you, Xavier. I think, so generally it's true that in the alternative space we see the fund size growing in general. In the last decade, that's completely true. But at the same time, it's interesting to benchmark impacts with, let's say, other asset classes which may face similar difficulties, and typically VC, venture capital. Still, a big VC fund would be around 100, 150, 200 million. Not necessarily like you could have on the private equity or infrastructure or others with those mega funds. And I think, Marius, when we discussed about the risk perception as well in around the impact. So it's not only about the size, but there is particularly an element around the risk perception. Can you tell us a bit more?
Sure. I think oftentimes the gap between fund investors and fund managers, in our experience, comes from a misperception of risk. And if you look at the world of impact finance or impact investing today, contrary to some of the premises that were formulated 13, 14 years ago, it's not a clearly defined asset class with a risk-return characteristic that is set. Rather, it is a term that is used across the board, from impact-first initiatives, grant-making initiatives, all the way to large ESG or so-called funds that are launched by multinational or large asset managers. And because there is this wide spectrum, oftentimes what we find is that there is a mismatch between how risks are perceived by fund managers and by fund investors. Now, if you ask me where that the core or one of the root causes of that is, I think it comes from a completely different way of assessing risk, whereas fund managers oftentimes build proposals bottom up, where they look at they're focusing on a certain opportunity and the risks associated with that are more acute in nature. And as a fund investor, oftentimes there's a top-down approach where the risks that are perceived are of a completely different nature. And there is this mismatch that we're oftentimes finding in talking to fund managers and institutional investors on our side, which I think clearly one of the most basic ways of overcoming this is very clear communication on the side of fund managers to have a very clear positioning of a certain proposal. And on the side of fund investors, unfortunately, there's no replacement for hard work. It takes a lot of due diligence to understand where on the risk spectrum a certain proposal sits.
Yeah, no, I think it's it's clear, and in line probably with this question of risk perception. What we thought could help certainly is additional regulation. Of course, it will affect. It affects already smaller players, and impact players are, on average, small players in the alternative space. And what we thought could be to the benefits of the impact community as a whole, with this SFDR, this taxonomy, trying to maybe put the lights on the true players, on people trying to achieve sustainable investments. At the same time, it has been perceived by the market, by the impact industry as a hurdle or an issue. I think you wanted to discuss on that.
Yes, thank you. Maybe it's good indeed to just look at this from a bit of a historical perspective. So indeed, Kevin, what you mentioned 10, 12 years ago, getting institutional investors in was much easier. But really on the back of the financial crisis and the increased regulation, basically pension funds, insurers were just strapped on the risk because they didn't know what they were doing, and now they're afraid of doing exotic products. So that's simply a fact that we have to deal with, and we have to explain and explain. What has happened, and I think that's a good thing, is that probably 10, maybe 8, 7 years ago, the more established players all have become AFMDs of their own. And I think that has been a big step forward. And also as a sort of a small piece of advice to the smaller asset managers, impact asset managers, really make sure that when you invite private investors, particularly institutional investors, that they recognize an environment when they come in. Even at the door, you have to have the proper setup. But indeed, the opportunities are such that SFDR, I think it's a move in the good direction, but it's obviously prohibitively punitive for players like us. I mean, it's just far too costly. One of the most impactful funds that we have is actually Article 8, because we just can't get the data. So I really hope and think that in sort of when SFDR 2.0 is launched, that this will be reckoned with, because in principle it's potentially a labeling is good for us, but I think it has to be a level playing field. If you sell kiwis and crisps and you only have to explain why kiwis are healthy, and somebody who sells crisps doesn't have to do anything, that's just not the way to go. And I think regulators will come to see that, but we really have to advocate for this constantly.
Yep, and in that perspective, it's good that indeed SFDR is being audited in a way, and we can expect some changes. Although for the time being, I don't think there will be any revolution, but
it's
we'll
a process.
See. Yeah. I think a point you all mentioned in common is a bit around heavy burden which means as well heavy costs. And I think SIGA, as a service provider, you're very well positioned to know that cost is also one of the key elements, which is an issue in the impact sector.
Yeah, and I mean, more from maybe an operational perspective. I mean, bringing all of this together, all the good points that have been mentioned, mitigating the risk that is perceived by the investors, addressing the higher level of complexity in the impact field, and the additional regulation that has been put in place. I mean, all of this results in additional cost for the fund managers and capacity requirements in a way, which with the in combination with the fact that these funds are generally small in the impact field, results in a very high TER that impacts eventually the returns, of course, of the fund.
Yeah, and so I think at the end of the day, so we highlighted some objective reasons why impact is being difficult for impact players to attract capital. At the same time, the impact industry has tried to find solution, and one which is an obvious one is the blended finance model. I'm sure everybody is very familiar with that model, and why maybe blended finance has not been the game changer everybody was thinking it would be, and I think as well, I know Xavier, you are quite positive as well on the blended finance model with quite success stories as well on your side, so yeah, maybe you can talk about it.
Yeah, positive with caution, let's put it like that. No, I think maybe something, historically as well, blended finance has always existed, right? So it's been coined blended finance in the last probably 7 to 8 years, but when we, and I think Triple Jump could agree to that as well, when we raised the first microfinance funds 20 years back, we already benefited from public, actually, support at the time in order to structure these funds. So we actually used to call them CDOs at the time, and CLOs, it's a dirty word, we don't use it anymore. It's been banned from our vocabulary. But basically ensuring that you can benefit, right, from a scarce public source of capital in order to bring in private money. So the pioneering strategies, right, of microfinance without blended finance at the time would not have led to the industry, right, without this public capital to what it is today. Today we love to speak about, the large size microfinance funds that in some cases are up to $2.5 billion and are only invested by pension funds and private money, but this would not have been possible with blended finance. The question is, can we replicate the same with other sectors in impact investing? It's easier said than done in reality. And I think some of the slides that Maria Teresa showed us earlier today actually point towards that. There are positive elements, but there are some question marks as well. One of the slides that she put up with raised a question for me. I don't know if she's in the room, so I cannot ask the question directly, but it spoke about crowding in commercial capital. Underneath the commercial capital was defined as DFI and multilateral development banks. This is not what I call private capital, right? So, or commercial capital. While they tend to invest with a commercial approach, I think if we want to achieve, the UN SDGs, it's the capital markets, the insurance companies, the pension funds that we need to target in order to get there. Otherwise, we can have multiple panels of that sort, right, and speak forever about it. We need to crowd these guys in. So we discussed about regulation, but blended finance can help. But blended finance is also not for the faint-hearted, right? I mean, engaging in the fundraising of a blended finance product takes, well, let's say 24 to 48 months, on average 46 months. You have to be a bit of a masochist to do that. It's very exciting. It's very challenging as well, right? And ideally, you bring the type of capital, that are pension funds. How much first loss is required is also a discussion, right? Because I would always advocate for more first loss than less, but believe it or not, in some cases, when you go and meet pension funds or insurance companies with a large first loss piece, they actually refrain from looking at the opportunity, thinking that it's way too risky for them to consider to start with. So blended finance has, its pros and cons. It's a balancing act, I guess. I'm generally positive. I think we all are generally positive, but with caution again.
Yeah, and I think around blended finance, something which usually is highlighted by managers is that it can take some time. It can take some time to line up as well more public type of investors, and I think we wanted to ask you, Marius, how potentially an asset manager can accelerate the pace of public money being invested in the fund.
These are very strong words, Aurélien. I think, look, we could talk about this at length. To me, the one core item that needs to be on the side of the fund managers is pragmatism. The pragmatic fund managers tend to be the more efficient ones. There has got to be an acknowledgement as a starting point that development finance institutions, broadly speaking, operate within an institutional framework that is policy driven. So in that context, to spend weeks trying to change the wording of a side letter provision that we know all goes against the very DNA of that development finance institution is not a very productive use of anyone's time. So I would think that's just a very specific example. I think more broadly speaking, my advice would be to fund managers to perform somewhat of a due diligence on their own side on the investors that they're looking to target, because that helps to inform a strategy for fundraising early on, and it avoids giving the impression of a random fundraising approach. Oftentimes the question comes, why exactly are you going to this specific institution? And the answer that we're sometimes getting is very weak.
Okay, I think it's fair enough, and I can imagine as well that, as you pointed out before, Xavier, the market is very atomized. So there are many fund managers, especially in the impact, many first-time fund managers, and probably this is as well one of the reasons why these are less investment ready when they come to you than more well-established fund managers.
I think, look, this goes also to the core of the development finance institutions. Us, historically, we have an almost even split between first-time fund managers and established firms. So there's just to say that there's no starting point that avoids this level of interaction. What oftentimes we find is more of a hurdle is that we spend time on things that in our view do not matter and are impossible to change by the very nature of the institution that we are.
Yeah. Thank you, and I would say as lawyers we are well aware of the fact that sometimes it doesn't make sense to spend all the time negotiating something which is just not negotiable. Yeah. Thank you very much, Marius. I think, Siga, we pointed out the issue around the size of the funds. Can the impact sector be more ambitious? Of course, there are those big MIVs, we know, but in general, do you think, just being a bit more ambitious in the fund size could help?
Yeah, I think it would help, and I mean, in response to the issues that we have pointed out, namely being, the capacity requirement and the cost and the complexity just to set up a fund and manage a fund in current environment. That's one thing, and the other thing from the other side of investors that you mentioned before, that the ticket sizes are at certain level. When you talk to private institutional investors, they sometimes, or oftentimes, their minimum ticket size is too large for what these funds can absorb. So I think yes, they can be more ambitious in terms of size, acknowledging at the same time that this doesn't apply to all impact strategies, but in some cases it's not always fully scalable. So it's not always the solution to just have bigger funds and bigger fund managers. Sometimes you need to aggregate, think about aggregating as well, because you need to be close to the market. You need to have people that are really in touch with what they are doing. But on the funding side, you need to kind of think about aggregating and finding solutions. And while the ICFA is doing a really great job in accelerating and working on capacity building at the level of first fund managers, we want to have more fund managers in the market, but I think it's also the role of the fund managers and maybe ICFA as well to think about how do we better collaborate between each other. How do we, sometimes there are opportunities to merge teams because they're looking at very similar things. There are solutions like multi-manager funds, where you can have, and I spoke about the Global Gender Smart Fund before. There we work with 3 different investment advisors, and we manage the fund as one fund, and we do the fundraising as such. This is a solution that is possible. Fund of funds, I think we can have more fund of funds supporting different SDGs, supporting different strategies, and using these platforms that are available in the market to aggregate.
Yeah, and I think it's very valid. I think all the industries speaking about more of those kind of aggregated solutions. And for instance, you can imagine that impact fund of funds would be to the benefit of the market as a whole. So yeah, very interesting trends to explore. And I think in the VC we have seen as well more and more fund of fund strategies. So I can imagine, otherwise I like to make the benchmark with the VC, because I think they are people facing on average similar issues as impact players. Of course it's a different approach. And we can learn a lot from the way they have been growing as well as an asset class. We were talking about the risk perception, blended finance as a way maybe to mitigate perception. But I think, Stephen, you mentioned the fact that we really have to go into demystifying the risk into the impact funds, and that could be one of the key option as well to facilitate the crowding in of private capital.
Well, demystifying sounds very challenging. There's no magic wand that I can wave, but I actually think that the risks surrounding impact investing are not too different from the normal investment risks. It's just adding a third dimension, the impact dimension, which adds the intentionality and the focus on the outcomes. And I think for every investor, there is a space in that 3-dimensional model. You just have to be very, very clear and not waste each other's time where you are from a proposal perspective as well as an investor perspective. And I think there's place for DFIs and blended finance, particularly the anti-cyclical nature of it, which I think I value very highly. But I do think that institutional and private investors should be interested in being in the space in the first place, and that blended finance would be a sweetener. I think that's a very important aspect. And you do see institutional players already fiddling with that 3D model. It's just that I believe that the incentives are not strong enough yet. Because, and then preaching for emerging markets, I do think there are plenty of opportunities there with the growth rates in Africa, decorrelation. I think the market is still inefficient, which means that excess returns can be made. But obviously there are risks, and I think, in mitigating them, you should at least go for, I think, a local platform. You need to back, I think, managers that have a local presence. I think that will be risk mitigating, not only from an opportunity perspective, but also ESG risks. When things go pear-shaped, it's adamant that you have feet on the ground. And to your last point, I think it's data. It's upon us. We are really not there yet in terms of data. Data to convince the larger players. We need to collect it. We need to actually show what the value is of a first loss, of a guarantee. Because there's also illogical behavior from institutional investors because they don't know what a 30% first loss is worth. I've gone to institutional investors with a protection of 80%, which effectively gives you a lower risk than bonds, than government bonds, and they don't buy it yet. So I think on us, we have to do our homework, get the data out there, and prove that this can be financeable.
I think it sounds like a good plan, and generally speaking, you know, we're getting closer to the end of this panel, and we wanted to focus more on solutions. So I think what you're saying now is, you know, a way forward for asset managers to crowd in more capital. And I think I wanted to ask all of you, you know, in 1-2 minutes, what could be the solutions to crowd in more private capital or accelerate the pace of crowding in that capital. Xavier?
Yeah, I think one aspect that Stephen, you touched on, is also speaking the right language, and the language that is understood by the different types of investors. Because even if we are targeting the same product in a blended finance vehicle, they all speak a very different language at the end of the day. I mean, there are some non-negotiable items with DFIs. Public institutions have a very focused, you know, impact objective in mind. Institutional investors take decisions very quickly and get bored, you know, if the fund is not raised as well. They want to use very specific indicators and metrics. So it's up, you know, to us as fund managers as well to ensure that we actually properly cater to their needs. And it starts with data gathering and offering the right indicators and speaking the right language to actually label it and paper it properly, you know, for each and every investor type that we target in blended finance. One aspect as well is also the instruments, right? Because, and the vehicles. So as a manager, ideally you have multiple vehicles that you can actually offer investment for and ensure that your instruments actually precisely, you know, catering to the needs of each and every investor. We have a tendency to think that our strategy makes sense, and it does. I mean, I would say that most of us, you know, in the room that have been advisors of, you know, pioneering strategies understand what's happening on the ground in these markets, but often we cannot reconcile, you know, basically the investments that we do on the ground with how we package an investment opportunity with these different layers of investors as well. In some cases, we need to offer liquidity. In some others, investors are willing to stay for the long run. In some cases, it needs to be listed as well, and there are ways to do that, even with private funds, especially in Luxembourg. So you need to be more creative, right? Creativity in working with good counsels as well, making some advertising to you guys helps from that perspective. Something else, and you spoke about partnering and working together matters, right? So we are currently engaging with an advisor that has been the recipient of ICFA to operate as their manager for the fund that they're launching, in order to offer, you know, our investment process, our tools, our ability to support when it comes to regulatory matters on SFDR9, for example, and facilitate fundraising to an extent also. So these JVs or these cooperations are also important. We can't, you know, have 500 fund managers managing $1,040 million fund in the future, right? It doesn't make much sense. We need to further cooperation in the sector.
And I think that was what you mentioned, Siga, as kind of aggregating either through tools or partnership to indeed facilitate the fundraising. Siga, on the solutions for the future?
Yeah, well, solutions for the future, I don't know, but just to point out, I mean, there are things that we can do as service providers in Luxembourg as well, and, you know, globally, it will not necessarily attract more private investors. I don't know, maybe not, maybe indirectly, but at least in supporting the impact fund managers. starting by having willingness to really understand the business and the complexity around it. We do see, and it's linked to the size, the small size of the funds. It's getting more and more difficult to find service providers, banks, etc. in Luxembourg, and it's very costly. So. Finding, first of all, showing willingness, trying to understand the complexity of the business, putting in the necessary, and innovating to find solutions that are more feasible for these smaller fund managers.
No, that's true, and I think the industry, at least in Luxembourg, is trying to organize itself to fight against those. Pain points, which are pain points of the impact industry, but of course all the VC and other small players. Yeah. Mais?
I can only talk about what we are trying to do. I'm not sure whether this is the silver bullet solution, but we're trying to leverage the position that we have as the European Investment Bank, which on the one side is a multilateral development finance institution, and we spend a lot of time and brain cells on structuring different products to channel capital towards where it is needed. And on the other side, we are a AAA rated bank with a large balance sheet. So our very DNA is focused towards commercial sustainability, and everything that we do is structured in that way. So what we are trying to do is we are trying to link this to the previous points that were made. We're trying to bridge the gap in the communication where we see that there is a misperception of risk, for instance, or other items. We try to understand both sides of the story and have multiple initiatives. Like we have one in particular called Boost Africa, which is focused on venture capital funds, and it's been in operation for the last 7-8 years. Venture capital funds in Africa, where we're trying to bring together through different programs and different initiatives, fund managers to exchange expertise, talk about their pain points, and I think everybody's trying at this point to leverage the position that they have in the market to unblock these pain points. That's what we're doing.
Thank you, Maurice. And I would say I'm almost about time. Last words for Steven.
Yes, thanks. I would just, Marius, I think, made an important point. We've spoken about size, about setup, about speaking the same language, about risks, but indeed, how can we create more investable opportunities? And that's exactly by sharing knowledge and knowledge transfer. We are in the lucky opportunity that we have a fund with 35 to 40 first-time managers, and we want to bring them to market. It's a lot of hand-holding, but that's the time you have to take to make sure that enough investable opportunities for the DFIs, but also for the private investors come to the market.
Thank you, Steven. I don't know if we have time to take questions. Maybe one question, apparently. I don't know if there are any questions actually from the audience. Yes, Jörg. Yeah.
People online can hear it.
No, just maybe an add-on on what you said, Stephen, about SFDR and SFDR 2.0. I think that's a very important.
Just so that the people online can hear.
So Jürgen Hammer from SPDF. SPDF, for those who don't know, is the microfinance network working on the coordination of the sector for standardization and transparency in reporting. And I think the issue you mentioned is very important. The regulation that has come up now is certainly a step in the right direction, but as you said, you have funds that are very impact-driven, and they have to register under Article 8, because we have a specific environment in the south. I think it's really important, and it's also, I use that as a call for our sector to step up and do this kind of advocacy work. It's new, but this regulation is concerning us, and we need to make sure that an SFDR 2.0 does reflect and allows to be comparable and put everybody on the same level, as you said, an equal level playing field. So not so much a question, but really a support to what you said. I think that's a very good example of an impact fund that doesn't fit into where we currently stand in terms of regulation.
No. Thank you, Jürgen. And I think, in general, we mentioned, you know, a lot of communication, maybe partnering more, and probably this is as well part of getting a bit more professional, is to be able to lobby together as an industry. We know, of course, that VC, PE industries, you know, through Invest Europe, for instance, very prominent associations are lobbying, are discussing the new drafts at EU level, and it's, I think, very important as well that the impact industry is able, with one voice, to influence the potential regulations to be sure that it remains relevant for the impact industry, because we need more impact. I think we are all clear on that. Thank you.
I'll allow one more question because we started a little late. Any other questions?